This new bill is very exciting. We want to talk about some different areas. The new tax bill made it 100% bonus depreciation for all assets purchased after January 19, 2025. That provides incentives for capital investments. With the new law, it's up to 23%. So we got a 3% increase in that deduction. And then it is also, this QBI deduction is continued to be allowed for real estate and real estate investment companies.
Tim Fargo. He's a client CFO here at Rose, as well as our tax partner and CPA over at Rose. He's been here at Rose since 2006 and became partner in 2007. Tim Fargo has over 30 years of experience in accounting and business management, including 10 years of being a CFO of in the nonprofit sector. Tim has helped our clients here at Rose navigate complex financial landscapes, tax planning, and providing that financial clarity our business owners need to achieve more.
Let's dig right into the bonus depreciation Section 179 deduction. So first, let me give you a little bit of history on the bonus depreciation. Based on the TCJA and the previous bonus depreciation, it was phasing out, going down from 100% to 80 to 60 to 40% this year, and then next year it'd be 20% and zeroed out. The new tax bill made it 100% bonus depreciation for all assets purchased after January 19, 2025, and that provides incentives for capital investments. And so this is for businesses to purchase assets and they get this bonus depreciation, but it can be assets such as equipment, vehicles, anything related to maintain the business and qualified production property for that business. So one important thing to remember, and when we talk about this, is bonus depreciation is on that equipment, but you also get Section 179 depreciation, 100% depreciation for certain equipment. So when you're looking at depreciation, it's really important to analyze what type of asset that is and also what type of depreciation you want to apply to that asset. So it's going to be important to start to separate those assets down so you get the best benefit of your depreciation. So on the next slide, it's really just talking about when they go in place. So it's property placed in effect after January 19, 2025. So anything you've already bought this year after January, and also any future equipment. So it's important to look at those purchases here this year. And then also we want to really identify what areas would qualify for the best type of equipment. On Section 179, they did increase the limit up to $2.5 million of total purchases. So it does really increase the allowed of purchased equipment using 179. But that does have a phase out of up to $4 million. So that's when we really want to analyze, if you go over $2.5 million, do you want to then take the bonus depreciation or shift it through 179? And it's important to really analyze that when you're purchasing your equipment and planning for it.
So as a business owner, Tim, what plans should business owners be making, to take advantage of this new 100% immediate depreciation?
So what business owners really need to, thanks for the question, Ted, what business owners really need to look at is, what equipment do I need now and what equipment do I need in the future? As I'm expanding my purchases, do I need certain vehicles? We want to try and take advantage of the depreciation as in alignment with both your company's profit, but also accelerating that depreciation as much as possible. So it's really looking at the asset purchases that you need to buy. Now we'll talk about the next area, which is the qualified business deduction. This was created back in 2017 for business owners. This is for pass-through entities. The qualified business deduction is a deduction that pass-through entities, S-corps, sole proprietorships, and some estates and trusts can take, but it does not apply to C-corps. And they can take this deduction, and it flows through from their K-1 down to their personal return, and you get a deduction based on hiring employees, wages. There's a calculation that has to happen. Any business owners who have been in business, this had been set at 20%, and it was a great deduction for those pass-through businesses. It actually now, with the new law, it's up to 23%. So we got a 3% increase in that deduction. And then it is also, this QBI deduction is continued to be allowed for real estate and real estate investment companies, and they follow those same real estate rules in terms of what qualifies and how you can take that deduction on your real estate. This 3% increase on wages could be substantial for most business owners, and this helps helps really reduce taxes for business owners. And this is called the 199 flow-through deduction. The current rate is 20% in 2025, and then effective 2026, it goes up to 23%. It's really going to be used for planning when you're planning out next year and understanding what your taxes are going to be, make sure that you put that into your tax planning so that you're going to have individually a lower tax liability by 3%. And then if you are starting any real estate companies, make sure that's in your tax planning for the real estate if it's a pass-through. So a couple things that did change that some companies are upset about, but it did change. We are sunsetting some of the energy deductions for new construction. It's not affecting 26 or 25, but it's going into 26. There was a deduction per square foot energy deduction. That's sunsetting as of June 30, 2026. So it's important if you are in the construction area and you are building, it is important and you qualify for this energy deduction credit. Please make sure that it does get completed by June 30 of 2026, or you'll just lose that deduction. Same with some of the home energy credits and some of the home equipment. Again, that's sunsetting June 30, 2026. So it's going to affect the new construction and some of the new sales of the homes sold and getting those energy credits. Those are still good for 2025, and they'll be going away in 2026. Let's talk a little bit about some of the innovations and areas that business owners should be thinking about in employment initiatives. We're going to talk a little bit about the R&D, which is a large area, and then a few other small business credits or deductions. One of the biggest changes that came out in this rule is it's changing the R&D deduction for domestic R&D from a 5-year amortization to 100% year one. So the actual expense isn't changing, but it's accelerating the depreciation to be 100% deduction for domestic R&D and manufacturing. What that means is that R&D expenses for 2025, so this is valid right now, is if you have any US-based R&D, you will get 100% deduction on that this year. You will then be able to still take the credit and you'll get the deduction. So it's a double benefit. It does have to be US-based there, and it has to be creating a new R&D product. So it has to follow the same R&D rules. There is a benefit that they added in there that if your revenue is less than 31 million in overall revenue, then you can go back this one time and go back to 22, 23, and 24 and do a change in accounting method and reassess your R&D as fully expensed. So you take them accelerating the depreciation on that. And that significantly will help spur US-based domestic R&D because companies will want to do it domestically. Nothing has changed for foreign R&D. That's still set. You spend it now, you got to spread that over 15 years. So there is a big difference. US base is 100% year one. Foreign R&D is amortized over 15 years. So it is a big difference.
So Tim, this is really a big opportunity for firms that are investing in R&D, including process improvement. Now, can you give us an example of how a firm can benefit from this opportunity in 2025 and beyond?
Sure. Great question. I actually have one here on the next slide. This example is a $10 million firm. It's a product development firm that is preparing and doing their R&D in the U.S. And this example assumes $2 million of U.S. R&D spend in 2025. And what this shows you is that in the old law, if you spent the $2 million, you have to spread that over 5 years. You would get a $400,000 deduction, amortized deduction, and you'd have to spread and defer $1.6 million of that over the next 4 years. In the new law, you can take that whole $2 million in year one. That then reduces your taxable income in year one. Now, it will increase your taxable income in year 2 through 5, but you get the benefit now of that reduced taxable income. And that passes, again, this will pass through, so then it can reduce your federal tax liability. It used to be you'd only get, based on this example, $84,000. Here you could get a total of $420,000 in tax savings in year one. Now, the biggest benefit that you have there is you can align the deduction with the spending. So you have $2 million, you then get that deduction of the $2 million in year one, and it allows the cash flow to align. Where in the past, you had to spend $2 million and you would get that tax benefit over 5 years, so you'd have a cash deferral. Immediate expensing is strong because then you can plan that when you're planning your tax and your estimated payments. So you can put that into your planning. And again, in addition, I just said the $31 million, if you're below 31 million, you can take the prior years and accelerate those to the 100% depreciation for 22, 23, and 24. So that is important to remember. So that could even substantially in 25 make your taxable income even lower.
From an accounting perspective, what are the big system updates that a company would need to make sure they have in place just to really make sure they're in compliance while they're preparing to take these R&D credits?
Well, it's important to make sure that they're tracking the R&D expenses, which if they've been doing in the past, they should be following the same rules. But you have to make sure you're tracking the labor separate, the direct expenses for R&D separately, both the software and the hardware that you're using for R&D, and then you're tracking those with a specific purpose of those to make sure they qualify for the R&D purpose. And then if they once they move from R&D over to operations, you're moving those over to operations. So it's make sure you set up your chart of accounts to follow that, as well as when you're recording those payroll and other expenses.